Okay, the module 4 completely concentrates upon what is the impact of interest rates on the markets and what are the various ways in which the interest rate fluctuations are taken care by the industry. And this is referred to as the interest rate markets, and this is what we'll be discussing today. So if we look at the concept of risk, I'll be just going back to your um, investments little bit. Now, when you discussed regarding risk, risk was nothing but what? If I invest 100 rupees, there is always a possibility that I can lose 5 rupees or I can gain 5 rupees. Since there is a loss which is involved, this concept was always referred to as a risk component. So the possibility of me incurring a loss of, it might be 5 rupees or 10 rupees in a financial transaction, was always referred to as a risk. And you came across two things when you go for capital asset pricing model, or when you take arbitrage pricing theory and everything else, you will come up with the concept of what is called as the expected returns. Now, what is expected from this financial instrument 1 year from now is nothing but is your expected return. But you will be able to notice that what you actually realize, there might be significant differences between what is expected and what is realized. And you will be able to notice this difference which is there between actual with respect to that of expected is always referred to as a risk component. So we will get return, the return might be realized or expected. The difference that is there is always referred to as a concept of risk. Now, if that is the case, you will be able to notice that you came across something called as
ತಗೊಂಡೋಗಿಲ್ಲ.
the two concepts of risk. One is referred to as a systematic risk. Now, systematic risk is the one which will impact everyone, all the industries, all the companies are part of the industry, and all these industries are part of the economy. So anything that happens to the economy will impact the industries. Anything that impacts the industry will be seen on the companies also. So this is referred to as a systematic risk, which is referred to as an undiversifiable risk. And then you have got unsystematic risk, which is diversifiable if you go for portfolio. So if this is the case, you will be able to notice that within the systematic risk which was there, what was not dealt in depth during your investments is, if you look at the systematic risk, you have something called as the interest rate risk, you have got market risk, and then you have another concept of what is called as a purchasing power risk. So if that is the case, you will be able to notice that if I do consider interest rate risk, specifically with respect to the bonds that you have, bonds and debentures, you will be able to notice that if the interest rate changes, if Reserve Bank of India decides to make any changes to the interest rate, then automatically what happens is there will be some impact on the bond prices. They will be either sold at a discount or a premium. This is always referred to as in terms of the interest rate risk. You have something called as a market risk, wherein depending upon the economy, whether the economy is in the expansion phase or depression phase or in recession phase, the industries will also be able to perform accordingly. And then you have got something called as a purchasing power risk, which is directly impacting in terms of the inflation. So if the interest rate increases, what would happen is every person will go and invest into fixed deposits and various other instruments, and thus the amount of money flow will be very, very less in the economy, and thus it will lead to, you will be able to notice, since the money flow is very, very less, people don't spend much, there will be uh, lesser money to purchase anything. So we will not find the prices increasing. But if there is more money in the economy, that leads to something called as the inflation. And if the prices increases, we will not be able to purchase much, and this leads to what is called as the purchasing power risk. So you have got three concepts here. Systematic risk. Within systematic risk, you will be able to notice in finance or in financial derivatives, the interest rate risk is somehow connected to everything else. So if the interest rate increases, inflation automatically decreases. So by me taking care of the interest rate, I can take care of the inflation. Similarly, depending upon which stage am I in the economy, I can make corrections like Reserve Bank of India does. If the corrections are done, you will be able to notice the market risk will also come down or go up accordingly. So if this is the case, you will be able to notice when we talk about in terms of the unsystematic risk, you have got depending upon whether a company has got more fixed assets to variable assets, which is often referred to as a business risk, or the financial risk will be nothing but whether the company has decided what part of the financing to be done using equities or in terms of the debt component. That is always referred to as in terms of the financial risk. But our concentration in this module is completely on the systematic risk component. Within systematic risk component, we will be mainly concentrating on the interest rate risk component. So if that is the case, before you can understand the interest rate risk component, you should be able to understand the debt part. Okay, so how the companies will be able to receive the money. Either they will go for stocks or either they will go for in terms of the bonds. Now you will be able to notice that one way of raising in terms of the debt is in terms of, there are two concepts which you have learned. One is in terms of a bonds which are assured. Okay, they are assured, there is no problem with respect to whoever is issuing it. We are completely sure that they will be able to pay the coupon payment as well as the principal payment. In India, what we do is anything which is government issued, we always refer to that as a bonds, and whatever is issued by the corporate is always referred to as in terms of the debentures. Now when you go for debentures, we will be able to notice bonds or debentures now can be used interchangeably. That the assessment of the bonds is based upon two concepts. One is in terms of the principal amount that we will be able to receive, and then how much is the interest that we will be able to get regularly, which is referred to as in terms of the coupon payments also. So if this is the case, within these bonds or in terms of the debentures, you also have a concept of the company can decide to call back the bonds, but they will be able to ensure that they pay more to the investors, which are referred to as callable bonds, or the bonds can be converted into shares after a certain period of time, which are always referred to as in terms of the convertible bonds. So if this is the case, you will be able to notice that there are certain key terms which are there, which you concentrated upon in the previous semester in investment, is in terms of the coupon rate. Okay, so how much is the coupon which is given, and we know that the coupon will be decided based upon the face value of the bond. So if I say the bond is giving you 5% coupon or 10% coupon, so 10% on the face value, which is 1000, so the coupon will be 100 rupees. But what currently the companies will be, or the investors will be mainly looking at is, if a company is giving you some coupon or annual interest rate when compared to the current market price, because we know that the bonds can be issued at discount or the bonds can be issued at premium. So what is the current market price? So annual interest to the current market price, you will be able to notice you get something called as a current yield. Now if the bond is being issued at a discount, you will be able to notice the current yield will be higher. Similarly, if you will be able to notice, if the current market price is actually very, very high, then the current yield which is there will be very, very low. So what does it signify? Can one of you tell me? Can one of you give me give a try as to what do you think is the current yield? Because you already have the formula, annual interest to current market price. Anyone wants to go for a try? Okay, so all of you just remember that when we talk about current yield to current market price, what we always believe is a person will go and buy the bond at the date of the issue. But what happens is there are secondary markets also. So you can go and purchase the bond anytime. Okay, so if you go and purchase the bonds or debentures anytime, at what price are you actually buying it? The current market price. If it is lesser than 1000, so let's consider the principal amount as in terms of 1000. So if it is 1000 rupees, you will be able to notice if it is now 800 rupees, in order to compensate for the annual interest payments that you will be receiving over a period of time, you will be able to notice you go for 800, but you will be able to receive during the maturity period, current yield will be higher than what is initially, which is nothing but if it is 10 percentage, you are getting like 11 percentage or 12 percentage. So this is always referred to as in terms of the current yield. And if a bond is not paying you any coupons at all, what is the interest rate which is charged by that bond is always referred to as in terms of the spot interest. And if I want to calculate the amount of rate of return that an investor will be able to get at a certain period of time is always referred to as yield to maturity. So you have got yield to maturity concept here. So if this is the case, if I want to calculate this yield to maturity, always remember that this is similar to your internal rate of return, and these problems were done in the investment class also, wherein you had to calculate the amount of rate of return that the investor was able to get, which is nothing but the current market price of the bond. So what is important here is the concept of what is called as bond pricing. Now, depending upon these 5 characteristics, the concept of this entire module is based. So I want you to go through these 5 principles correctly. So first one is, we know that bond prices will move inversely with respect to market interest rate, which means if a bond is giving you 10% interest rate, so let me take the snapshot, 1 minute. So here, notice okay. So first one is the bond prices are inversely related, which means if the bond is currently giving you 10% interest rate, this is 10% interest rate. So if the market interest rate is 11%, you will be able to notice, if I am the investor, if I am going to be the investor, my inclination will be always towards the market, because banks are paying 11%. So why should I go for the bonds? So only way that the bonds can attract these investors is by decreasing the face value. So the face value, if we consider it as 1000, the face value will automatically decrease to 900. It will decrease to 800. Like that, you will be able to notice, in order to ensure that the investors will come and buy the bonds, the face value of the bonds will automatically be decreased. So bond prices move inversely with respect to market interest changes. Similarly, if the market interest rate is 9%, if it is 9%, you will be able to notice that investors will all come to the bonds. So if all the investors come to the bond, what happens here is you will be able to realize that since there is more demand, okay, since there is more demand, the amount of the face value of the bonds will automatically start increasing. So depending upon what the market price is, you will be able to notice that if the market interest rate goes to 9%, investors will be attracted towards the 10% bonds, is due to the reason that this will be able to give them more benefit rather than in terms of going to a bank which pays only 9% interest rate. So this is one concept that you should be able to understand, and you all know it. So the second concept which is there that you can notice here is the bond price variability. So we will always consider the risk component which is there is directly related with the term of the maturity. So if that is the case, you will be able to notice the changes in the bond prices are greater for long-term maturities, and thus if you are an investor, if you want to invest into the bonds and if you want to speculate, okay, so if you want to speculate, you will always look for the bonds which have longer term. Okay, so this is one aspect that you should be able to remember. And the sensitivity of changes of the bond prices in the market interest rate increases at a diminishing rate as the time remaining until its maturity increases. So you will be able to notice this is the concept which applies similar to in terms of your forwards as well as futures also that you have learned. And this is the concept that you understood is, if I'm taking in terms of the future prices, if this is the future price, and if I consider this as a spot price. So in the exam also what was given is, what do you mean by derivative is, derivative is an instrument which derives its value from the underlying instrument, which is nothing but the spot prices. So if I'm talking about ragi, or if I'm talking about wheat, if the spot price of wheat is 10 rupees, we know that for this wheat I should be able to store it for 6 months, which is nothing but the storage cost. So the future price will be, for example, it will be 12 rupees. Now if the spot price keeps on fluctuating, similarly the future prices also keeps fluctuating, and then you will be able to notice each and every futures and forwards will be for 3 months. So this is far month. The initial month is called as far month. You have got the mid month and you have got the near month contracts. The fluctuations which are there near month as well as mid month, the fluctuations are too many. Okay, so the fluctuations will be higher. As you come closer, to the far month contract, last month you will be able to notice the volatility which is there will slowly become less, and the future prices and the spot prices will meet each other. Okay, so if that is the case, the same concept of the bond also applies here. So what we are saying is, when we are talking about the interest rate, if there are any fluctuations in the interest rate initially, the bond prices will fluctuate a lot. But as the bond prices near its maturity, no matter what the fluctuations in the interest rates are, it will not move much. So this is one concept. And the next one is you will be able to notice that the price changes which are resulting from equal absolute increases in the market interest rate are not symmetrical. This is the same concept that we learn in investments also. So what do we understand in investments? If I take this as time period, if I take this as the stock prices, you will be able to notice if these are the stock prices of the company. If there is a bad news here, okay, if there is a bad news here, you will be able to notice that the markets will decrease very, very fast. Okay, there will be a contraction with the existing trend. There will be a contraction or in terms of depression, and the prices will decrease something like 25%. Okay, so it will decrease by 25%. But if there is a good news, for example, if there is a good news here, if the good news is obtained somewhere here, you will be able to notice that the increase will be just 5%. Okay. So which means the markets react to bad news much faster rather than in terms of the good news. This concept also applies with respect to that of the bonds, wherein you will be able to notice any changes in the market interest rate which is downside. Okay, if it is decreasing, will have a significant impact on the bonds when rather than when the market interest rates increases. So this is one another concept. And then you will be able to notice that the last one is nothing but the bond price volatility is related to its in terms of the coupon rate. And we always know that percentage change in the bonds price due to change in the market interest rate will be smaller if its coupon rate is higher. So you will be able to notice that if I do show you the bonds, some of the bonds are having in terms of the coupon rates which are much higher, 10%. Few of them have got 10.5%. Few of them have 11%. So depending upon the coupon rate, you will be able to notice the price volatility also changes significantly. So if this is the case, so once you have the concept of in terms of the bonds, when we go further with respect to the risk, you will be able to understand now that when we talk about specifically with respect to the bonds or in terms of the debentures, we know that the risk component which we will have, it will be mainly on one is there any possibility of whoever issuing these debentures will default, either with respect to the principal amount, either with respect to the coupon amount. This is nothing but the default risk. And for this reason, what we do is before investing, we will take help of the credit rating agencies, and then we'll say, if the credit rating agencies have given A plus or AA plus, then there is more stability with respect to earnings of this company. So we can go and invest into these debentures. The other concept of risk applies is with respect to interest rate risk. So if we are talking mainly in terms of the concepts here, and bond duration is, you will be able to notice that if I know that the same concept of your present value of money, wherein if I know that the interest rates are, or the coupon rate will be obtained for a longer period of time, say for example 20 years, at the end of 20 years I will get the principal amount which is there. Now if I want to find out the relative size, okay, so if I want to find out the relative size of the present value of these cash flows, you will be able to notice that according to time value of money, whatever amount comes first, it has to be given in terms of the more weightage. But you will be able to notice that the here the duration is nothing but it is the weighted average measure of the bond's life, where the weights are designated depending upon at what time period we will be able to get it, and then we are trying to find out the present value. This is always referred to as in terms of the duration. So if this is the case, you have any questions at this present point of time, all you have to understand is there is a concept of what is called as a risk. So you have any doubts with respect to concept of risk? Okay, this is this is what you had, okay, in investments. But when we come across the forward rate agreements, now you know that there exists risk, right? So when you know that there exists risk or there exists a component of risk, how will the companies be able to manage risk? Is through what are referred to as the forward rate agreements. So so you know in terms of the forward rates, okay, so you have understood the concept of forward contracts. Now can I use the concept of forward contracts to ensure that if the interest rate changes tomorrow, if the interest rate goes up or goes down, it will not have too much impact on the loans that I have taken, loans that I have lent, or in terms of borrowed. So this is referred to as the forward rate agreements. So first and foremost thing is, now what we'll do is you can just log out, okay, you guys can log out, you can use the same link and then you can join in another 5 minutes, okay, so we can start this concept forward rate agreements all over again. Got it? So you can all log out. Let's join in another 5 minutes, okay.